Hello, everyone. Firstly, I would like to thank all the participants who have taken the time out from their busy schedule and joined us today for the webinar that we've organized. So, my name is Vikas Agrawal. I'm the founder of a company called AIF and PMS Experts India. So, we are emerging as one of the largest platform for investing in alternate investments and portfolio management services. So at AIF and PMS Experts India, we strongly believe that we should try and educate all our clients and empower them so that they can take the informed decision. And therefore, we keep organizing these knowledge-based sessions. And the whole idea of organizing this session is to invite industry experts and read their mind. And that is why we call this show as Ask the Expert Show. So welcome to brand new Ask the Expert Show. Firstly, thank you, Varun, for accepting our request and taking the time out. Truly appreciate that.
Thank you. Thank you so much.
Yeah. So let me have the privilege of introducing Varun first. So he brings about almost 20 years of experience, almost 2 decades of rich experience when it comes to equity investing. He's from ISB. He's completed his MBA, and he's worked with large organizations like Nippon Mutual Fund, which manages about more than $14 billion worth of assets, and he's also worked with large houses on the quant side, small cap side. Very versatile in terms of experience managed large funds single-handedly, did complete analysis, really outperformed the benchmark significantly. And with now ValueQuest, we are launching a new fund as well. So today we're going to talk about that. So without any further ado, I would hand it over to Varun, and Varun, you can take over from here. Thank you.
Thank you for the kind introduction. Welcome, everybody. I'll share a small presentation which will cover our firm and the product in discussion. Uh, if if it can be confirmed, if the screen is visible and clear.
Yeah, very much. Maybe you can put it in slide view. Yeah, that's right.
Yes, yes, yes. Yes. So just to briefly begin, ValueQuest, I will introduce the firm, but this discussion is about a PMS strategy called Poise, which is basically about three building blocks. The science, the art, and vision coming together. But I will discuss that all along. Um, so, in terms of corporate overview, today, as a firm, ValueQuest is close to 11,500 crores of AUM. Uh, 65% odd, two-thirds odd is the institutional AUM. We also manage a large sovereign mandate. Uh, as founders and as team members, our capital is invested in our own and is part of the firm itself. So we have complete alignment with our investors. Uh, as a team, we are today almost 65-member team. We are 25-member research team out of that, and this 40-member, which is administrative operations, IT related. In terms of returns, the third tab, we have completed close to 13 years now. In terms of 3-year, 5-year, 10-year performance, that is for everybody to see. But with all humility, I must always add that past performance should not be extrapolated into future. Our endeavor would be that whatever we have been able to deliver in the last 5, 10, 13 years, we can continue that hard work and that aspirational numbers the next 10 years also. And that is how the team is structured, that is how we have invested in building not only a large team, but also a very, very talented uh, pool, very experienced pool. The investment team is Ravi, Samir, myself, and there's also our private equity head, Pushkar. Ravi has founded the firm, needs no introduction. Ravi and Samir actually started ValueQuest in 2009. I've come in 3 years back. This is the management team, which is going to take the business or the asset management platform of ValueQuest much ahead. Abhinav has joined us as Chief Business Officer. Hiten and Chirag were actually old hands. They were the old architects of ValueQuest. Abhinav, Ankit, and Anand have come in as their respective functional heads. I think we always have been known to be investors, to approach as investors rather than asset managers. So investors first is what we always call ourselves. This seemingly small difference actually makes uh, a hell and heaven difference in terms of our approach to markets, in terms of our attitude towards our work ethic and everything around it. The reason being, when you are invested yourself and you are providers of capital to our own uh, schemes and strategies, your approach tends to be more long term and more differentiated rather than trying to get the short term right. For lack of a better reason, it's investing is all about getting the 5, 7, 10 year right rather than trying to get a quarter or a year right. And that is where we always say wealth creation and where our focus is. Our focus is not on a day or a quarter or a year, but try and get the 3 years and beyond right. And to look over the horizon, you obviously need a lot of understanding around the softer aspects as much as the numbers, which is what we will discuss ahead. In terms of our industry framework, quite self explanatory: grit, which is growth, return on capital, industry tailwinds, and thematic. I think growth and return on capital is reasonably well understood. It's the degree and nuances that I will explain ahead. But industry tailwind and understanding themes, these two are something which require a lot of hard work. You need a lot of differentiated insights. You need to be ahead of the crowds, ahead of the media, etc., so that you can not only build your thesis, you can get insights much ahead of, you know, before they become headlines. It requires a lot of hard work. So the basic building block of research is find the right pond, because agar demand opportunity badi rahegi, so automatically the company will grow. If you find a small fish, even in a small pond, there will be a limitation to growth. So the simple concept is find the blue ocean where the demand opportunity is not only high growth, but also duration of growth. And that is why I think we are in the right country, that it definitely helps to be in a country as wide, as diverse as India. And as we grow, we realize that when the pond grows, the number of players actually reduce in terms of share of profits. So not only do you want the share of demand to be large, the demand opportunity to be large, you need a lesser competitive scenario, and that is the essence of this slide. Coming to the company selection, give me 1 second. Yes, in terms of the company selection framework, so we don't call ourselves growth investors, value investors, and large cap investors and mid cap investors. We actually don't understand these nomenclatures. They have been put for some reason, and it comes from some legacy. What we truly believe is that we want to invest in change of scale, which is our core philosophy. Which means that, I mean, if I have to simplify, 100 crore की प्रॉफिट की कंपनी है तो वो 300 करोड़ की हो सकती है क्या? 300 करोड़ की प्रॉफिट की कंपनी 1000 करोड़ की हो सकती है. And likewise, wherever there is change of scale, irrespective of the absolute number. So scalable companies with sustainable competitive advantage on a long runway with superior execution capability. The word execution here should be taken with a lot of weight, because execution is what separates the story and the numbers. So, like I mentioned, if you want to understand 3 years and 5 years and beyond, no rating agency, no annual report, no quarterly result, no broker report, no media, nothing can help you. Everything is more focused towards the next quarter or the next 1 year. But if you have to discover what is to happen as an outcome of the industry and company 3 and 5 years and beyond, these are the six building blocks. And this is where the ValueQuest team focuses on governance, structure, technology capabilities, culture, and partners. If you get to understand these six building blocks of the company, you will be able to deduce what is the runway, what is the level of execution, what is the quality of the business financial model, and a lot of other areas. Now, wealth creation has several aspects, but we tend to focus only on one, whereas there are three building blocks of wealth creation. We tend to focus only on the highest return, which is the y axis, whereas the x axis is duration and the z axis is sizing the opportunity or size of equity allocation. So let me just delve here. Return, it's about the degree of return, which I think uh, hogs 90% of the limelight, but it's also about the quality of return, the replicability of return through market cycles, the predictability of return. Are you doing something where you are in some way speculating with the possibilities rather than playing with the probabilities? So that's about return. In terms of duration, ability to adapt through cycles, ability to sustain through cycles, and ability to deploy large capital. I think the combination of all the three is going to determine one individual's or a corporate or a fund's how do they compound over long term. It's the interplay of these three factors. I can't overemphasize that. Unfortunately, only the percentage return in a single year or 2 years hogs most of the limelight. In terms of myself, for me, this is one investing has always been the one single idea that has driven me right from my school days or from my childhood. I have grown up amongst investors, amongst investing, surrounded by only and only investing stories. Last 22 years of full time experience, of course. Around 10 years of non institutional experience and around 13 years of institutional experience, but this presentation would be available, so I will not delve deeper. So before I move to the product, I would indulge in some basic building blocks. So investing is about, to my mind, this is my view, about three factors. We tend to focus more on the science, which is the academic part or the process part, but it also has two other parts to it. So the first is being process of elimination or selection, the other being understanding and interpreting intangibles. I think in this world, if you do not understand people, technology, patents, IP, or all these intangibles, you are going to be left far behind in the way the world is moving. And I can't mention the word AI, which is already so omnipresent these days, which is nothing but actually part of intangibles. And third is vision. You need to be positive. You need to have the vision. You need to see beyond what is visible to you. And for that, you need a lot of connecting dots so that you have clearer vision over long term, even beyond what the promoters might say, the industry might say, the rating agencies might say, brokers might say, etc. So the first principle of POISE, the PMS strategy that is in discussion, is that it's lower the risk, which leads to higher return, contrary to popular belief, contrary to what academia has drilled us. So if we focus on higher probability and more predictable opportunities with narrower range of outcome, we are able to magnify and increase our returns. And if I have to simplify this, मैंने अपने करियर में यही देखा है, and markets are enough evidence that good businesses, good industries, good promoters have always surprised us on the way in a bull market in terms of stock prices. In an up cycle, they have delivered higher than expected growth, but even more in a down cycle, their resilience of growth in or balance sheet metrics, etc., or their simple resilience of being able to maintain cost structures, they've all surprised us. So never underestimate uh, goodness or good promoters, good management teams as such. That has always been our Achilles heel. I think most of us share stories around why we may have sold earlier or given into some macro story and got out of the market. Second, first principle is that just like in society there is inequality, just like in society there is uh, there is unequal distribution of wealth. Similarly, in capital markets, few companies create wealth. Few companies within the industries command the revenue and the profit share of the industry. That is nature's law. That is nature's design. We should not be. It's more academic to believe that it's the world is normally distributed, but it's actually more a function of power law. Big companies tend to become bigger. Uh, great teams, great managements tend to gain more market share and tend to surprise. So, coming to the product contours of this PMS strategy, uh, it is a a PMS strategy which is built for all weather rather than a bear market, bull market, which is more always hindsight, anyways. So it's the combination of faster cap, high capital efficiency companies, low frictions to growth, and quality growth at reasonable price. I think the word quality has been overused, abused. It's more cliche these days, but it's more hygiene, I would say. One cannot brag about it, but growth at reasonable price. Valuations have a significant role in contribution towards return. I will explain these four terms here in very simple words. Faster cap, like I said earlier, we tend to get trapped into words like large cap, mid cap, small cap. But actually, what really matters is faster cap. If there is a company which is large and growing fast than a small company, that is what matters. And let me delve deeper here. In some industries, let's say lending, let's say insurance, there are, let's say, a lot of manufacturing areas. Large is an inherent advantage. In several other industries, which could be IT, which could be some parts of software, uh, maybe small is an advantage. So we have to understand that difference and that nuance. Secondly, high capital efficiency. Agar India may cost of capital is itself 12%, 13%, why would I be interested in companies which are at least 1.5x their cost of capital in terms of their, IRRs or ROE, ROC, balance sheet metrics, etc. But up here, I want to put a caveat that not all companies that are not reporting accounting return ratios are capital inefficient. There are some companies which are very, very efficient on their usage of capital, even though the accounting may not reveal. Uh, Rest, I think, is self-explanatory. In terms of portfolio strategy, 3 to 5 year rolling view, faster cap. There's no model portfolio. It's more focused on elimination, and I will explain that. I think elimination is a science which is completely underrated and is half the battle in the market. Uh, it's a balanced portfolio without, I think, investment framework is quite clear. I've discussed it. Uh, I don't have any constraints in terms of capitalization sizes, value and growth, sector or themes, old economy, new economy, concentrated versus diversified. I don't want to be trapped in any of these nomenclatures. What matters is a all-weather approach. This is amongst the most important slides of the presentation, where I show you uh, how is the portfolio constructed. So, for example, left is the market, the entire world that is listed. Let's say in India there are more than 3,000 companies listed. But if we apply certain size and scale and liquidity, you will arrive at close to 1,000 odd companies. And then if I eliminate companies which are very capital efficient, both subjective and objective methodologies, we arrive at close to 220, 250 companies, which is 20% universe. And on that, we have to obviously get into the more intangible aspects and valuations and growth to be able to construct a portfolio. And if I have to share why this process is there and how has it worked, is that, let's say on the left graph, this is the market, the entire pie, and 20% of this market is my universe. This universe itself outperforms the benchmark reasonably consistently over most periods. So uh, 70% on an average companies as part of the universe. So let's say there are 100 companies in the universe, which is 70 companies. In this case, there are close to 200 companies, so close to 140, 150 companies. The universe itself is outperforming the benchmark. What it does is reduces my errors of commission. The biggest source of drag in returns or lower alpha is always errors of commission. कि मैंने I did a wrong purchase in terms of company. So these are the three errors which a fund manager and I am trying to manage through a process. Pehla error, error of commission. Ki how do I reduce my error of commission? First way is I have a curated universe, which eliminates a good part of my errors and the possibility. Second is our internal research process is very, very deep, very good breadth, and we have now more than 15-member research team, which helps me do that. And the third is we have access to all the institutional research. We have access to most managements at the first level and at the second level to be able to address that. An error of omission and an error of sizing is relatively simple to understand. Error of omission is what I did not buy that worked out. Again, their team matters a lot. If you have a team which is covering your blind side, if you have a team which is presenting you with emerging trends, and you have a sounding board, that really, really helps a lot. And the final being error of sizing. And the sizing, I have four buckets usually. That is much more simpler to understand. Now, in terms of expectation setting of this, it's a multi-cap, multi-cycle, all-weather fund approach. And the whole thing is, can we invest large sums of money and be at peace through market cycle? The destination might be the same from point A to point B in terms of returns, but how you reach the destination through what volatility matters a lot. Final piece is the portfolio performance. The fund is completed 2 years. We are just doing a launch right now, but it was managing our own capital, our internal capital for last 2 years. This is last 1 year, 6 months, 1 year, and 2 years performance. In terms of the distribution of capital, like I've always emphasized, we are not in this large cap, mid cap, small cap game. We are multi cap. Our weighted average market cap is 76,000 crores. and median market cap is 19,000 crores, which shows that we're investing in sizable companies without taking undue risks. So all the alpha is coming from very large companies. The graph on the left, the pie on the left, shows 62% small cap. Now, there is a little bit of a regulatory distortion here. The definition of small caps is moving dynamically because the country is growing, markets are growing. So, the right metric to look at is the median market cap and weighted average market, which is very sizable, as I show. Well distributed, reasonably balanced portfolio. And since 2 years, since the fund began, this is the difference on uh, BSC 500 versus the fund. I think this is uh, our essence or our culture. Final slide is that I always say our teams and externally that we are in the right country, in the right age, we have the right ecosystem, we have the right experience of last 25 years of being in markets, seeing at least four bull markets and four bear markets, which helps a lot. Uh, I think all we have to do is work hard to and not be complacent, not be arrogant, and that's about it. Thank you so much, and I could take some questions, Vikas, or take some clarifications.
Thank you, Varun. Thank you for sharing this wonderful presentation. A lot of things to learn. Great.
Thank you.
So, a couple of questions. So, one is, why is this named as poise?
Yeah, yeah. So the word poise is so I'll tell you, I'll explain it. Let me show this slide, and this will be very evident. So in capital market, in markets, the markets attract the wisest and the smartest of talent. This is one area of the economy or of professional life which attracts the best minds. Having said that, unfortunately, IQ is most overrated in market. It is EQ, which is behavior, which is emotional quotient, that is really the biggest advantage. So that's why you'll find some of the most successful investors in the market are from psychology background. And
Well
अपने क्या
said.
बोलते हैं कि बनिया बुद्धि. What is baniya buddhi? You get it approximately right. This is not a market which can be understood by complex models, Excel, or hard code numbers only. There is no evidence of it succeeding. So, what is poise? Poise is basically a single word which communicates balance of mind. You need to have behavioral, uh, you need to conquer yourself behaviorally before you try and understand the science of market. There is a method to madness. There is a process for sure. There is no doubt about that. And that is why I come back to that there are three building blocks to alpha. If you're able to conquer the first two, your returns will be, see, okay, 1 second. Luck by design, right? If you want to get lucky in market, first be in the right market, okay? अगर आप US में होते 80s में, even if you throw a dart, you would have made a lot of capital. Similarly, in 2003 boom onwards, India में last 20 साल में, even the index has given 16-18% CAGR. Versus the Chinese 1,000 companies are 20 years behind. Hong Kong is back to 1995. So if you are in the right country, half the battle is won. Second, if you are part of the country, how are you able to select the right industries? Okay. Within industries, if you've selected, can you select the top three players? Either the leader, the challenger, or the disruptor. Either of the three. Which, and these three can usually be dynamic promoters only. They can't be complacent promoters, or they can't be complacent family driven businesses and all that, right? There needs to be hunger, there needs to be ambition, there needs to be execution to be able to get to become either of the three. So now if you're able to have these three, which is right country, right industry, right business financial model, or promoter, because ultimately promoter is what decides the business model, right? You are automatically lucky in delivering far ahead of the index. Okay. The fourth point,
Sure.
there are a lot of industries and a lot of opportunities that are not part of the index. So if you buy a passive fund, unfortunately, you're going to miss out on a lot of underbelly or a lot of dynamic promoters that are emerging from small caps to future mid caps or future large caps. So effectively, you just have to do these four things, and you are so poise helps you with objectivity, with emotional quotient, so that one, you're able to eliminate half your errors. Second, you're able to select without any constraints of index of ये कंपनी तो खरीदनी ही है just because last 10-20 साल में अच्छा हुआ है. So there are, for lack of a better word, the previous leaders are never the future bull market leaders. So that agility is very important.
Got it. Thank you. The other question is how is it going to be different from your other two portfolios, which is growth and platinum?
Yes, yes. That is a question which is very important for sure. So, see, the passive answer is every asset management firm have has more than one fund manager, whether it be a mutual fund, whether it be a PMS or an AIF. What it does is it brings strengths of everybody on board. So the key principles of ValueQuest, which is industry framework and company selection framework, that remains common to all the strategies of ValueQuest. In fact, these extend to even the private equity side. Okay, so that's the common part. There are always other unique things. What are the unique things between of poise versus other two? My strengths for the last 12-15 years have been towards consumer technology, light engineering, manufacturing, and such areas. Sometimes there are cycles in which heavy industries, which is capex cycle, PSUs, also perform very well, which is actually the current cycle. Poise is more built for investors which can put large amount of capital, are looking for maybe second quartile return for long periods. See, what happens is everybody has 100 rupee and you put 10 rupees in a small cap fund, and that is giving probably a 25-30% CAGR. But what people forget or miss is that the intent is to grow the entire 100 rupees at high teens or 20% CAGR approximately. Poise is designed for peaceful, more scalable ability to manage large capital with low volatility and higher predictability. It takes a little lesser risk in terms of industries and promoters. So, a lot of cyclical companies, a lot of government companies sometimes will not make the cutoff in this strategy. And of course, it has its strength in terms of ability to deliver the returns through more defensive opportunities rather than be very aggressive.
Sure. So, kind of rapid fire, quick questions if you allow us.
Sure.
So, how is the allocation going to be between large, mid, small, or it's a bottom up approach?
It's very, very bottom up. It's more, I would say, an outcome, not a conscious design. So when I'm investing in a company, I'm investing for scale change, let's say 100 crore का profit 300 crore जा सकता है या 300 crore का profit 1000 crore जा सकता है. uh, at that, I'm not investing because it's a small cap or large cap. It will be reasonably well distributed. The number that we focus on is that our median market cap should be, well above 15,000 crores or 20,000 crores. Weighted average market cap should be reasonably high. But ये small cap, mid cap, large cap का definitions keep changing, one. And दूसरा, what is today? So the smallest mid cap today is actually 20,000 crores, which is actually quite large. So as asset manager, uh, with the intent of delivering long-term good returns, this is not a decision-making point.
Will you ever consider team-based investing also in this portfolio?
Yeah, so we identify themes and we write it. So, for example, we are very, very positive on manufacturing, and within manufacturing, renewables, uh, and the whole gamut of renewables, certain areas of light engineering manufacturing, which is coming up because of renewables or because of semiconductor manufacturing, because of railways, defense, so suppliers, and so it is thematically oriented. But again, this is not a thematic fund. The themes will change over cycles. Today, what is a theme may not be the theme 3 years later. So, absolutely, when I say grit as the industry selection framework, uh, theme investing is very important. We try and look for three themes and let's say one or two companies each. If there is around 15 companies in the portfolio, six or seven or close to 8 to 10 would be where I find strong tailwinds driven by those thematic work.
Sure. My last question. So that's not about the presentation. It's about what's your views on the markets. With that, we'll conclude the session.
Yeah, that's actually the most difficult session. So, okay, let me give you first the dissection of the market. Okay, so I started my journey. Let me stop the screen share. So I started my journey in market around 2001. So it's been 22 years. But even before that, my family was in the market since 82. Uh, Now I have seen at least last 25 years. I have clear memory and understanding of the market. Markets have changed color and composition many times. And I'll tell you why I'm telling you this. So let's rewind back to the 2003, 2006 cycle, pre 2008. The market was about a few industries. And let's say in a year, if FIs were buying 30,000 crores, it was big news. There was a period when only one group of companies were rising, and that was making the index move. There was only one industry doing well, and that was taking all the capital and all the limelight. So we have gone from a market composition where one single group or export driven industries and FIs were calling the shots to, in 20 years, multiple driven industries. FIs do not matter as much. It's more domestic capital as important or even more important. And no single event, no single group, no single industry is dominating the market. So the breadth and the depth of market has changed so much that today it is not a one bull market or one bear market. Within the $4 trillion $4 trillion market, you can have a bull and bear market coexisting. So today, in some way, we are in a bear market in large caps, and there is a bull market in small caps. In 2018-19, there was a bear market and a very big one in small caps. There was a bull market in large caps, right? And these themes, these market structure rotation will keep happening. In US, large caps are in a bull market, small caps are completely crushed. They are in a severe bear market. So that is why I'm saying Nifty, Sensex, or the market is not the right representative of our discussion. Today, India is about close to 12 super sectors and close to 60 sub industries. The hard work or the alpha outcome would be those who understand India, Bharat, Hindustan, the 60 industries within, rather than going for headlines called Nifty, Sensex, GDP, macros. No. And I want to show you a slide that is very dear to me, which will show this evidence.
Are you also concerned about the valuations? Maybe you can cover here.
I will cover valuation, yes, and I will show you. This is the data of two market cycles and three countries. Okay. So if you see on the left, 61 to 1995, 33 years, the world grew around 21 times, which is 10% CAGR, the world GDP. But if you see below, Japan, the GDP went up 100x. Korea, the GDP went up to 30 times. Okay. Now, that's one. Okay. That's the left. Now, let's look at the right. If you see 1994 to 2013, 18 years, the world grew 3x. But China GDP grew 17 times. India GDP grew 6 times. What I am trying to say is I am not in favor of this chatter and this narrative that the world economy has to grow for India to grow. There is too much of focus and too much of mind share towards uh, that there is so much of problems in the world abroad. All economies are in trouble. How can India not? How can India really grow? So that is the evidence on that. Now coming to valuations.
I have a question here quickly before you put
Yes.
up your slide. So when you talk about China and their market cap, so when you saw that they were growing at 17, what about the market cap? Did also market cap went on the same lines?
Yeah. So till 10 years back, Chinese markets were actually I have the data. Uh, One second.
Because what we hear is the Chinese don't get the desired valuations. To what extent
That's
it
what I'm saying now, because narratives keep changing.
sure.
Last 10 years has been very bad for Chinese markets. But if you see preceding that, Chinese markets were the biggest. So if you see 2003, SARS happened, and post SARS, the Chinese internet boom happened. The Alibaba, the Tencent, the Pinduoduo, the Meituan, all got created during that boom, right? So the Chinese saw internet boom, a manufacturing boom post 2003, which ended maybe 7, 8 years back because of so these themes, this narrative. And let me bring you another example: the Fragile Five. In 2013, India was called the Fragile Five, right? And today we are anti-fragile one. We're the only ones probably which are in the anti-fragile category. Reason we are anti-fragile is probably because we have the least external debt. Our corporate leverage is the least in the world.
Please have your water.
Yeah.
Please take your time, sir.
Yeah.
Yeah, so to read your mind the same lines, so maybe you continue.
Yeah. Yeah. So coming to valuations, okay, and obviously it's a very important debate these days. And
Yeah, because we keep getting a lot of questions and people are concerned about the valuations. And when we sort of discuss with them, try and explain that they're saying that markets are overvalued and we might get some correction and that is the time to deploy. So what are your house views on that?
I'm so sorry, this some problem with the screen. Yeah, is my screen visible on the valuation table?
Yes.
Yeah. Okay. So now again, I would caution the word market. Okay. When we say market, different people have different connotations and interpretation. The media might know it as Nifty or Sensex, and somebody might know it at BSC 100 and 200, and somebody might know it as BSC 500. I would say today, market, the word market, needs to have the second level interpretation of what the structure of the market is. Okay. So let me show you. This is the industries that are the composition of the market. Okay. There are close to 20 industries, which total to $4.4 trillion market cap. This 4388 is in trillion dollar. So $4.3 trillion market cap, $170 billion of profit, $230 billion of cash flows. This is what India is about. $200 billion plus of cash flows with the lowest leverage, corporate leverage in its history, and also the lowest leverage across the world. Imagine if you have $200 billion to deploy, to grow, to reinvest. The wealth effect in markets has been because of that. In 2019, our corporate profits were 5.5 lakh crores. Okay, approximately they listed. Today we are at 13 lakh crores. Despite 2 years of COVID, despite two wars, despite interest rates going up, banking crisis, all the thing. Now coming to your question on valuation. Okay, so if I divide the market into one, two, three, four, five segments, okay, top 50 companies, 150 companies, micro cap, and all that. If you see the top of the market, which is mega caps, are at 22 times, 23 times trailing P. If you see the micro caps, they're at 40 P. So when you say the market, we have to be which part of the market is overvalued or reasonably valued or undervalued. So mega caps and large cap command close to 84% of operating profit and close to 90% of the profits. And they are at 23 times or 25 times, give and take, whatever there might be. So the limited point is that we as asset managers, अगर 500 स्टॉक में से आप 15 स्टॉक नहीं निकाल सकते, which can give you a reasonable return. You may not be hitting it out of the park. If it can give you, see, what are the choices for our investors? Today, if you go to FD, you'll make probably 6% post-tax. If you go to gold, it's 6-7% CAGR. If you go to real estate, obviously it has its challenges. What are the options? The market is giving you 12 to 20% over cycles long-term post-tax.
Well,
It's about having the right expectation. It will not give you 20% CAGR at any point of time. Maybe from here, expectations should be lower because last 3 years have been 25% CAGR.
yeah,
But
my last question before we conclude. Um, so there are some large caps like HDFCs of the world, Kotak, uh, Bajaj. And by the way, we are just taking these names as an example, and there's no recommendation from either side.
yeah,
Bajaj Finance and Asian Paints. Now, if you look at they're today available at the same valuations what they were at during the COVID time.
sure.
My question is, when you say large cap, do you see these businesses are sort of likely to get their desired valuations, or you think that post COVID the scenario has changed, and because in the last decade it was a fearful situation and those companies became the darling of the street, and now during this decade there will be new names which will emerge.
So this is a nuance which is very hard for me to word, but I'll give you. See, the first thing is, why do we give a halo effect to any company? Because the previous 10 years have been that great. So our starting point as capital allocators, as investors, as fund managers cannot be that I'm giving undue attention to a certain company just because the markets loved them a year, 2 years, 5 years back. It has to be forward looking. If I find a company irrespective of what it was getting treated as good or bad, favored or unfavored 3 years back, but can grow at very good, let's say 20%, 25%, 30% growth in the next 2, 3, 5, 7 years, and is at a reasonable valuation, my decision is independent of the past. So, one, no growth is taken for granted. Second, nobody's leadership is taken for granted. New bull markets will have new leaders. There will be only a few leaders which will transcend multiple market cycles. Those are exceptions and not the norm, right? Third, I'll give you, and again, I'm taking names, but I don't intend to, but it's for illustration. There are certain large caps, let's say a Hindustan Lever, let's say a Infosys or a TCS, or I can name another 20. They're barely able to grow at 10% revenue. Now, in an economy which is at 12, 13% nominal GDP growth, why should I spend my time on anything that is growing at much more than normal GDP growth? Rather than, so why should the investor pay attention to the segment of the companies which might have had a glorious past, but they don't have as great a future in terms of degree of growth? That's the limited point.
But the
So,
whole debate about quality and non-quality, that crops up again in the sense that people say that eventually quality picks up, and no matter what the cycle may be. So to what extent you get aligned or synchronized with this thought?
so there is a old saying: every big company in the world, no matter how big it is today, was once a micro cap or a small cap. Okay. The word quality, what matters is rate of change. If a bad quality company moves to the good quality quadrant, the wealth creation is enormous. If there is a good company that becomes great, the wealth creation is very big. Okay. So the edge is an identifying rate of change. If you are buying into consensus, if you are overpaying for quality, for lack of a better word, whatever that quality is, and if that quality does not live up to its expectation in terms of growth over and above the normal GDP growth, then is it a trap? Just like we call value traps, you know, is it a quality trap? So we have to caution ourselves. You know, there are magazine cover indicator. There is an old thing that has worked for last 30 years. When things come on the magazine cover and it becomes the chatter of everybody's conversation, that's when it has reached a point of, in some way, maturity or halo effect. We as investors are looking for change of rate and rate of change.
Well
That
said.
is where the money is made.
Great, great. So with that, would like to conclude the session here. It was wonderful reading your mind. Got a lot of insights about markets and got to know about your portfolio, how you want to run. The positioning of the fund is now well defined in investors' mind that if they are investing in POIs, how it is different from the other two portfolio that you've been managing with a superior track record, more than 10 years of track record of delivering more than 20% kind of CAGR
Yeah.
returns. So with that, we'll conclude the session. Thank you.
Thank you, Vikas, for the opportunity. Thank you, everybody, for joining.